Hello and welcome back to the Geordie Pig Investor channel. Today we are going to have a look at, is Alphabet Inc. stock a buy right now? What is Alphabet? Ticker symbol GOOGL. Also known as Google, it is a holding company which engages in the business of acquisition and operation of different companies. The firm segment include Google Services, Google Cloud and other bets. Google Services includes products and services such as ads, Android, Chrome, hardware, Google Maps, Google Play, Search, and YouTube. Google Cloud includes Google's infrastructure and data analytics platforms, collaboration tools, and other services for enterprise customers. Its Google Cloud provides enterprise-ready cloud services including Google Cloud Platform and Google Workspace. Its Google Cloud Platform enables developers to build, test, and deploy applications on its infrastructure. Its Google Workspace collaboration tool includes applications like Gmail, Google Docs, Google Drive, Google Calendar, and Google Meets. Its hardware products include Pixel phones, Chromecast with Google TV, and the Google Nest Hub smart display. The other bets segment is engaged in the sales of internet and television services, licensing, and research and development. Some key stats about Google: they are based in the United States. They are part of the media/technology industry. They have a market cap of a massive 1.8 trillion. They went public in 2004, have over 150,000 employees, and have a dividend yield at 0.27%. They don't have a dividend growth streak or a 5-year growth rate because they have only just introduced that dividend. Over the past 12 months, Google is actually up 8.91%, but in the recent weeks has had a bit of turmoil and has been down a considerable amount. So in today's video, we're going to have a look at, is Google stock a buy right now? Google's earnings call and fundamental analysis. In Q2 of 2024, Alphabet's consolidated revenues grew by 14%, reaching 84.7 billion, with Google Search and Cloud being significant contributors to this. The operating income rose by 26% to 27.4 billion, resulting in a 32% operational margin, and Google Cloud crossed 10 billion in revenues and achieved a 1 billion operating profit for the first time. Alphabet anticipates continued revenue expansion, particularly in AI solutions, and expects operating margin growth for the full year of 2024. On top of this, they have saw massive growth within their YouTube subscription services by a 14%, and also the company has announced a 5 billion investment in Waymo to enhance its autonomous driving technology. Fundamental analysis. Google has a positive free cash flow of 60.8 billion, has exceptional 3-year return on invested capital at 31%, has positive operating income at over 101 billion, positive gross profit 188.7 billion, positive net income at 87.7 billion, very good short and long-term solvency, has an extremely low debt-to-equity ratio at only 0.04%, has a very high Altman Z-score at 14.12, and has a positive 3-year revenue growth at 14% alongside a negative net debt, meaning that they have a positive cash flow of over 87.5 billion when taking away debts. Next, we're going to dive a little bit deeper into Google's free cash flow. Free cash flow is the money a company has left over after it's paid for all of its expenses and any investments it needs to make to keep the company running smoothly. Free cash flow is going to have a massive impact on the direction a company may be heading, because if it has a decreasing free cash flow or as in the negatives on free cash flow, the company is very much going to struggle to continue paying dividend payments if it has one, and also it's going to mean the company is going to struggle to actually reinvest into the company and continue growing it into the future. From this graph, we can see that Google has steadily increased its free cash flow over the last 10 years and was even able to continue growing it throughout the pandemic. It really only made sense to introduce a dividend payment for the company this size, as it's a great way for them to get rid of some of their free cash flow, but also use it by rewarding loyal shareholders. Google's continuing to expand, as previously mentioned with their recent investment in Waymo, and will only continue to add more assets and diversification into the company, especially when they have so much free cash flow to do this with. Not to mention that right now they currently only have a free cash flow payout ratio of 11%, so that's likely going to mean that the dividend payments should see solid increases year on year. Next, we're going to have a look into Google's discounted cash flow valuation. The DCF method is a method used to estimate the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flow based on selected operating models. Google's current price is $150, When plugging in a discounted rate at 7.6% and a terminal growth rate of negative 2.6%, on the worst case scenario, Google will be worth $105, which is an overvaluation of 29%. When using a discounted rate of 7.2% and a terminal growth rate of 0%, Google would be worth $167.03. And when plugging in a discounted rate of 6.8% and plus 2.6% terminal growth, we can see that Google would be worth $312.44. Not only do I have a look at the DCF model, but I also have a look at the relative valuation. And what we can do with this is add the two together and then come up with the intrinsic value. The relative valuation is a method used to value a company by comparing it to other competitors based on certain metrics. The metrics that I personally use for this are EV to revenue, EV to EBITDA, and I also use PE ratios. When plugging in my numbers, Google's worst case scenario price was $124.95. Their base case price was worth $141.83. And their best case price being worth $161.65. One thing I do want to mention is, with Google being such a premium and well-known brand, you've got to remember that for these types of stocks, you are going to be paying a slightly higher price and a bit more of a premium price due to the fact that it is a premium stock. Stocks like this are very likely to be still around in 10, 20, 30 years time, and you're going to have to pay that a little bit extra to have stocks that are so well known and likely to be around in that amount of time. Like I just mentioned, we can then get the intrinsic value. The way to get this is by adding the DCF valuation and the relative valuation together and then dividing by 2, and we will get the intrinsic value. On the worst case scenario, when doing this, Google will be valued at $115.10. On the average case, it will be worth $154.43, and on the best case, it will be worth $237.10. I not only use these two valuation methods, but I use a further valuation method as well, just to really solidify my prices when researching a stock. The third method that I use is Wall Street estimates. The Wall Street estimates are an average estimation of a public company's quarterly earnings and revenues that lead to a valuation of that particular company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. There are multiple analysts for companies the size of Google, and they are going to be working on it on a daily basis to come up with these price targets. On the worst case scenario, they believe that Google would be worth $171.70, up 15% on the current price. On the average case scenario, they believe it would be up 40% on current price, being worth $207.99. And on the best case scenario, they believe it would be up 66%, being worth $246.32. This shows that the experts are very bullish on Google stock right now at these current prices. Overall, like we just mentioned, we can then add the three valuations together and get an average for our worst, average and best case prices. When plugging in the numbers, we can see the worst case price was an average of $134, meaning if we had a 10% margin of safety on the worst case price, we'd be looking to buy at $120.60. And with a 20% margin of safety on the worst case price, you'd be looking to buy at $107.20. On the average case price, we can see it is worth $172.30. So with a 10% margin of safety on this price, you'd be looking to buy at $155.07. And with a 20% margin of safety, you'd be looking to buy at about $137.84. And on the best case price, we can see that Google stock would be valued at $240.10, meaning with a 10% margin of safety, you'd be looking to buy at $216. And with a 20% margin of safety, you would be looking to buy at $191.90. What does this mean? Is Alphabet stock a buy right now? I think the company is at a fairly attractive price right now. This is one of the most well-known worldwide recognized companies with extremely strong fundamentals. It has one of the healthiest balance sheets in the tech sector, with a large amount of cash that could be used for strategic acquisitions, buying back its shares, increasing dividend payments, or other efforts to boost shareholder value. The recent drop in its valuation is likely an overreaction to short-term challenges, ignoring the company's strong underlying business and growth potential. While there is some short-term difficulties, its solid financial foundation, diverse business interests, and lower stock price could make it a smart choice for investors who are looking for a bargain. Usually, well-established companies are always going to cost slightly more as they trade at a premium price, but now might be the ideal time to invest in one of the world's most innovative, recognized companies while it's trading at a discount. I hope you enjoyed today's video. Let me know if you currently own Google in your current portfolio, or if you're looking to add this potentially after watching today's video. What other stocks would you like to see a full breakdown on? Let me know in the comment section down below. Please like and subscribe. This is the Geordie Pig Investor, over and out.